welcome to this quick video. It theoretically would be longer, but I ran out of steam and it's a bit too humid in the my humble basement abode to stick around too long. But I figured since it is close to the 5 year mark, why not pat myself on the back and cherry pick a handful of top winners that I cunningly identified with incredible skill, and simultaneously I horribly failed to size in a meaningful way. Theoretically, I should be materially richer and closer to my magic number than I am. Theoretically, imagine that I took out a direct subsidized student loan and just YOLO'd it into App Lovin'. 5K into App Lovin'. That would be nice. Way back in 2022 with that semester's direct subsidized loan. That would be epic. Uh, and that actually would have been material. But and so clearly, again, everything I say is, if it sounds dumb, I don't mean it, and if it's smart, I do, and if it's something questionable or about how smart it is or whatnot, it's not related. But I figure since this channel is for my own benefit and for my future self, probably some point I should actually upload the audio transcripts to Spotify, to my podcasting. Uh, I just wanted to, since I felt inspired after walking around the National Art Gallery, and sort of similar, right? Like, think about what you can do with your marginal free time. And so so these are just two paintings that I saw that caught my eye. Um, and so this one, which is Woman with a Parasol by Monet. So the backstory for it is actually very fun, I think, charming, but it just shows that there's different levels when it comes to what a guy can do in his free time. So apparently, Claude Monet, so this is his wife, this is his kid, and he right impressionist painter. So he wanted to paint, like vivid watercolors and sceneries and whatnot. Again, generally, I was not an art major, although it did seem much more interesting and after going through the museum. But apparently, like he painted this so quickly that you can see like the gray in the sky. Like he didn't finish the sky because he was just trying to get his wife and his kid in the moment with the light. Yeah, like literally, like you see the physical manifestation of a guy's passion for his family and his effort. And again, like there's a tangible output that's skilled and shows craft and ability. Like man, I would be very impressed if I was him or her. And to contrast with that, here I am with this wonderful Google slideshow using a default template without any transitions, without even a title slide. And of course, there's 140 years or 170 years in between me and Mr. Monet. Uh, but again, it's always fun to contextualize things. And this one's Miss Marlowe. And you just said out because it's always fun to think about. Like, presumably, people in the past look different. The average person in the past looks different than the average person today. Certainly, like the average British person, or like even excluding like immigration and all of that, but just like conceptual, like you see the paintings of like of uh, of who got paintings at the time, like royalty or merchants, and of course, then there's going to be selection bias. But presumably, you'd think wealth self-selects for certain traits. And so, anyways, so it's always fun to see like one of these paintings, and Miss Marlowe is from the 1901 or something, so not too distant. And so it is fun to think about when the average painting person becomes like I could imagine this type of person being on Hinge or something, or on the street. Uh, you know, it's just funny. It's funny to think about. The same way, like, at what point does language become mutually intelligible. So, anyways, just fun random shower thoughts about the art gallery, but again, free to go to, and very pleasantly surprised by it. Again, in general, I vaguely remember seeing a TikTok that argued that going to art museums is actually a very good thing. Or it's not. It's actually a very top tier spot for guys to go to more. And I compartmentalize that. Although today I'm reminded that it actually is. That TikTok was actually onto something. But it was onto finance stuff. Enough true stuff actually has meaning onto finance. And so the top winner by a amusingly significant degree is app lovin'. Of course, again, to the prior point, I horribly failed to size it in any way that's meaningful. And again, like the dummy thesis, and again, to my point, like if it sounds dumb, there was much more thought that went into it. But conceptually, right, like, right, this was 2023, right, so if Meta got executed all the way in the back half of 2022, you had IDFA, you had just general interest rates and all the trickle on effect onto venture backed companies and just the entire like SEO marketing ecosystem directionally. Well, presumably, right? Like you need customer acquisition at some point, and so literally, ad spending is low, but at some point it should normalize and go up, right? Because right, advertising exists for a reason, to market services, to acquire customers, product differentiation. And again, that's very broad strokes. And again, to Apple Oven specific distribution channels in mobile apps as its primary focus, from my understanding. Again, it's very high level. Maybe if I spent a bit more time on it back in 2023, I could have sized it a bit more appropriately, given whatever asymmetry at 10 times trailing EBITDA, which presumably, again, right, given ad spending is going down, is presumably impaired trailing EBITDA that is not normalized run rate EBITDA. So if I don't know what they'll actually be, but presumably my EBITDA was even lower, or my multiple is effectively lower than what I bought it at for an advertising thing, right? So again, it was literally a dummy thesis, not much to it. And again, there was confusion, right? Because Apple Oven did offer to buy Unity, which would have been not as big of a change in the thesis as intended, right? Because people might think of Unity as being the game engine, but Unity also does ad distribution. I'm not sure what the actual revenue breakdown is, but either way, like the fact that that existing segment already exists could be it's not inconceivable for someone to for Apple of it to parlay and just size more aggressively into that market. And then of course, like even today, you have all the short reports about it. It is obvious that management is very promotional in a very obvious way. The same way Perplexity and its CEO is transparently obvious about how promotional they are. Same with these guys. Conceptually, I'm not opposed to that. You can say Elon is very promotional by nature. I do suppose advertising distributions a different business than hard tech SpaceX stuff. But and that's that. And then of course the alternative reality is I see App Lovin'. I have the genius idea to apply the same thesis, and I buy the trade desk instead, or in addition. And I'm not sure what the trade desk did today, but when I last checked, this incredible volatility. But over the past 5 years, which is relevant for this time period, and is effectively the same. And again, for the trade desk, again, from the type of diligence I would have done, my thesis would have been the exact same. Just ad spending was bad and is down, and it's going to go up and normalize. It's just like if you have duration, why not buy the cyclicals counter cyclically, right? Because you have duration, you can ride out cycles, and you will be appropriately compensated for taking the duration that somebody else can't, right? The marginal market participant probably can't take duration the same way you, as Joe Schmo, can. So why would you buy options when you can just take duration and be compensated on being the marginal buyer when people can't? But of course, in trade desk, they would have gone horribly wrong. And again, there's so much nuance to these actual ad models that I'm skipping by. So that was app 11. I can say more about it, but again, I don't want to reveal actually my lack of full understanding for the nuance. And again, right, like I like owning many random and by many, I probably have over or about 600 line items. But with the thesis, right, like it incentivizes me to learn more about something, learn more about things, and that knowledge will compound and be applicable. But when it is a $12 position, it is harder. But again, I mean, advertising is more interesting than like advertising, gaming, financials, loosely, like are more interesting. Consumer staple or discretionary, or conceptually more interesting than say consumer staples or healthcare. So presumably I should have been more incentivized because presumably I would interact with App 11 ads at some point. But again, like clearly, like directionally again to like that time arbitrage is just duration is my only source of alpha. It probably is, if I'm being very blunt. Is literally just duration and pain tolerance. But again, that probably means I'm not getting like maximizing skew or maximizing efficient returns or per unit of risk or whatever. But so I do think safe that App 11 could have gone marginally wrong for me. Robin the Hood. Again, this is my thesis. Basically, is trading way below peers at book value. And that's functionally it. So it's even dumber than the dummy thesis. Like it's a broker that's trading below comps. And again, that's not fair, right? Because Robinhood is very different from comps like Schwab or interactive brokers, and at face value is lower quality. Just like at say margins or the average size of the accounts, right? Because presumably, like your fixed cost per broker or per brokerage account is roughly the same. So you can argue that Robinhood needs to have operating leverage. And I don't know how many users it had at the time versus today, but clearly, given the run Robinhood's been on since its low, it's clearly A shown it has franchise value, and B it's able to uh, like actually have a durable franchise and to effectively like be a to effectively be like a consumer finance thing. And it is interesting, like again to like the alternative reality of something like SoFi. I think SoFi was much earlier to being very like one-stop shop for the consumer with its student loan stuff or all of its like mortgage or personal loan, student loan stuff, savings accounts, all of that. Like Robinhood did not certainly last year certainly did not have all of that functionality or product offerings. And so honestly, I didn't think about the point until just now, but it is fascinating to see how a Robinhood diverged from SoFi, or how they converge so quickly. And Robinhood, I think, is a much more attractive option. I think in large part because Robinhood isn't trying to be a bank, but SoFi is. And it's like SoFi offers brokerage services, but it's still a bank. Robinhood offers financial services a bank would, but it's still a brokerage. and that seems to be, again, a sample of one, but that seems to have been a much better play for Robinhood to have started out at the smaller base, outsource a lot of things, and then branch out once you have that franchise value and operating leverage. As, again, without having done a lot of following up to the SoFi story, I think SoFi is just running into bigger scale issues and all of that. As you said, right, figured before starting a full time job, you may as well buy options once. So these options were, honestly, I don't think it was the worst thing. I'm sure because the premium was literally $1, so it was trading at 1 cent. So like I'll punt $1, and presumably if David Zaslav ever decides, or John Malone ever decided to do something in the next week, something could have worked out. So I stand by it. It's not the worst thing, and conceptually, like, you would buy $1, spend $1 to have schmuck assurance on if John Malone ever wants to do another tax thingy majig or whatever. But again, right, to the point about Robinhood, right, it's nice to have a lot of small customers, but can always work better, right, just from like your fixed cost perspective. But again, I think at this point it's clear that Robinhood has achieved that. Just looking at it like a subscription, like they're offering Robinhood Concierge, where they'll deliver cash to you. They'll literally deliver cash to you. That is such a like, I guess if you're a business owner, like that's valuable. But that's like probably more of a marketing stunt. But it's the same way like credit cards, like Amex or whatever. Like you'll mail you things to do marketing stunts, or like Capital One, Ticketmaster partnerships, whatever. That just shows that like Robinhood, like it's now like an Amex or a Capital One or a Chase in terms of like what it's trying to do and what playbook it's trying to roll out. I think saying that now versus back in 2021 with GameStop or last year when the stock was at 10, like is fascinating. And again, right, again, like I just clearly haven't followed the story enough to have caught that, but it is fascinating how in retrospect how well Robinhood compares to SoFi, or how Robinhood is literally like positioning itself to compete against Chase or Amex in terms of what is, again, like that consumer thing. Again, it is fun to see all like different consumer stuff out there. Maybe doing something with buy now pay later, and just copying Patio 11's essay about it. That might be a future idea. Next, Spotify. Probably the real thesis is just, as a user of it, it's one way to rationalize the price increases and also no longer being on the student plan. And so having a 2x price increase from the jump. But again, I think at a certain point, scale does matter. And as dumb as it is, like having to recreate a playlist and you can't export your playlist, that is actually like, very loosely, there is like a symbolic for like network effect. I'm sure a different FTC or CFTC could have a different view on it and like mandate like an open source standard for exporting playlists, which actually is probably some churn impact from that. It would certainly be good for Deezer, or the thing that Square/Block owns. But again, clearly Spotify's certainly from the stock has been a huge winner. Of course, also back then it was at like 1.2x price to sales, not 7x. And presumably like, margins will improve just from Daniel Ek wanting to cut costs and all of that. And so presumably like you had some back then, back in 2023, 2022, you had some safety on your price of sales, right? Just because like that gross profit conversion is gonna improve, or operating profit is gonna improve just from internal cost optimization stuff. So you're kind of de-risked. Um, Again, you still have the same overhangs about the record labels. Like it's clear that the record labels have power with some people. Just looking at the TikTok standoff, although they did come to a deal, And again, I haven't read anything. Again, I'll let someone smarter than me inform my views, but I'm gonna come to a view on who has more power, the record labels versus everybody else. Certainly, like right now, of course, I don't have desktop audio on. It's just my mic, but I'm listening to uh, VHS by Matthew slash Video Club, right? The French pop group or indie group, I should say, to sound more sophisticated, right? And I sourced them through TikTok, and it's again that's not like any meaningful, but it just shows that like it's obvious how both parties bring value to each other, but it's not obvious who accrues more or should accrue more. Honestly, I'd probably say TikTok, right? Because if anything, TikTok adds value by being the distribution layer, whereas the record label, loosely speaking, is just a rent seeker. So if I had to pick, TikTok should accrue to value, or Spotify should accrue to value, not the rent seeking label. But again, the record labels would have a different argument, like they do a lot of. But again, it's not obvious because like the record label models change, from what I understand, and it's not like they're taking on like that proprietary investing risk these days as much. So again, it's a very very open question. And the other side, back to like the promotional management thing, like I do find Spotify's push into saying they're an audio company to be somewhat cringy, and it's just like it's not obvious. The monetization case and adoption and stickiness is just not as obvious on the podcast side. Whether it's exclusives, of course, you can always point to like the Meghan Markle podcast, but it's conceptual. Like it's not obvious to me how much of a hook Joe Rogan is. And I think with the new Joe Rogan deal, right, he can do more stuff on YouTube. So it just seems to me like audio or podcast just a commodity, and I don't think it behooves anybody to be stuck to a single platform, right? Like distribute your podcast on YouTube, right? Symbolically, the same reason why I stream on Twitch and I stream on YouTube. It it flatters my vanity to have more touch points with the internet. So that's Spotify again. So I think the questions are honestly still roughly the same, right? Like because you've always had like the user growth story. Like that's I don't think Spotify has had a negative quarter over quarter user growth thing. Your subscriber story is still the same. Like you are growing subscribers, you were still monetizing a bigger set. I guess maybe back then you still had like the same IDFA stuff from Apple. Again, it is actually fun to think about the story. What percent of companies were materially impacted by one company, Apple, making a decision? But at a high level, like the issues or the questions are still the same from back then as it is today. I think for something like Robinhood, where the story's tangibly different, whereas here is still the same, but yet the stock is done roughly the same thing, just going up and tunning it. It's fun to think about. Two more. Kind of want to take a shower, so we'll power on. So Super SGHC, Supergroup, and RSI, Rush Street Entertainment, Rush Street Interactive. So these are gaming companies, or betting companies. And so present where like, of course, everyone knows that like in the U.S. betting is very top two player, top heavy, but it's conceptual. Like you can have long tails in many industries, right? Like just look at like legacy media. You have a lot of like long tails thing. Just look at all like the local news channels that eke out a living from like local election advertising and all of that. So I think with that mental framework that you can have a long tail of companies that can eke out a viable living. And again, if valuation is appropriate, and if you could talk yourself into an M&A put, which I probably do too much, given the relative lack of M&A exits in my portfolio, looks at Krispy Kreme. And again, I think at the end of the day, to the degree to which it's fun to think about who is contributing to the retained earnings that you as a shareholder are theoretically entitled to. It's fun to think about who it is and diversify that. or just have marginally different exposures. And someone like SGHC, a lot of their sales come from Africa, which is different, right? Because you can have Latin America, right, with like CDRO, or other companies, or like Flutter has a presence in South America, in Asia, but just in general, listed companies don't really have that much direct exposure to Africa. And certainly when it comes to betting, it's not. So I just find it very amusing that I think it's literally like you have like a sleek mobile app, and then in Africa or whatever, I think some one of like the West African countries, there is like some regulatory enforcement, but like they'll talk about kiosks as being the conduit, and it's just hilarious from like Flutter's sleek, optimized app to eke out its 17% hold rate versus Supergroup's literal kiosks. It's like, both are viable business models, so that's okay. And again, this is just a great. It's not mine. I must have read something online October last year, but I just love this. Is such a good quote. It's a beautiful thing to have a gambling addiction. That's that's just great. And then meta is probably spiritually. It's to the failing to size something appropriately. This is massive, right? Because conceptually, like, in what world would meta have had zero terminal value? Not many. Probably, honestly, like, none. Because if things got so dire, you could literally just, like, turn the cash spigot all the way to the other way, and you'll be safe. So I think this is just clearly a horrible misidentification. And again, like, sure, the stock was getting hammered, so maybe that's why the marginal buyers were coming in. But then presumably I should have been entering, because again, to my point, like, duration is my only advantage, and I have duration, and I think beta is an easy story. Even if the story's wrong, it's easy to underwrite a version of it. I think that just shows though how bad sentiment was. I think like Twitter was like puking all over it, and people were like panicking about like literally like its terminal value, and I guess shame on me for letting that affect my view. But again, right, like buying something at 6 times trailing EBITDA, and then back to like Apple 11, right, like the EBITDA that presumably is lower than its normalized EBITDA because of IDFA and not working itself out and normalizing. So again, the EBITDA is actually lower in practice. But again, you still have the same, ad spending goes down, ad spending goes up thesis. Again, maybe with IDFA, there was some, you could question that. But again, like, you need to advertise some way, and Meta still has a lot of room where you can just, like, underwrite the Android part. So again, if I actually did work, I could have come to a different view or had more confidence. But again, same thesis, different world. I buy Snapchat on the same advertising down, so it must go up thesis. And again, maybe yeah, that would not would have worked out. Although again, it does seem that Snapchat's a very easy company to trade earnings on. But I will say on that point, just to end on a slightly philosophical note, I think it is clear that like, I think Snapchat's actually doing something interesting with their a couple of not call options, but just random things like their AR, like drone thing, or just AR in general, which they were pioneers in with their filters, or again, like, they do have a user base, I don't have a surface area, so it is again like it is a viable enterprise. Although, like, whether for shareholders or for the business or for employees or Spiegel, you can debate. Like, again, I find Spiegel. There's a book about Snapchat I have not read. I'm not sure if it talks about him and Miranda Kerr, but I just find, out of all the tech bros that are out there, like, I find Spiegel just be more interesting than the other ones, just like because he seems to live a different existence than those guys. Like, his stock is not successful. Everybody else's stock is successful. Other guys are more prominent on social media. Evan's not. Other guys are doing AI. Evan is still in charge of a, loosely speaking, a sexting app. And again, presumably just like Roblox, right? People age up, and it's still a sexing app, but but less unsavory. So I just find Spiegel to be a fascinating character, symbolically, for just like the slightly different incarnation of your tech visionary. But again, to read the slide uncharismatically, I think at this point it is obvious that Meta, it's not really a social media company, or that's certainly not the way like they're pushing it, right? Like the huge push into algorithmic and like integrating algorithms into your feed, like that's clearly a different, like the same way newsfeed for Facebook itself changed changed things, right? So like again, like simple heuristics, like how much content do you see from your friends versus algorithmic. It's like, well, the real answer is probably like how much do you use reels is probably like the real barometer for that. But that's a fair question, and just the fact that like just give us the money and we'll make AI ads for you, like clearly given the advertising houses stocks, like there is some risk of that actually happening, but that would be bizarre. Like it's funny, like on Metro, to see like the AI Skechers ads, and it's very questionable, like how much like they're clearly trying to go for sex appeal with the AI generated female things from like the pose, or like the fact that like if you squint, the AI thing is like presumably like an, an attractive woman, but it's very obviously an AI ad. And why not have a real model wear your shoes? You know, why have an AI? Where's the selection effect? What imprint does it leave in the consumer? It's just fun to think about. And presumably, if I'm a kid, I'm looking at that ad, I'm like, damn, Skechers is about that. You know, but I suppose I am not acclimated that way. But maybe in 10 years, like, that's the norm, and all, my priors will adjust to to AI ad sex appeal. What a world! But again, it's just fun. Like again, like to like, I think the big thing from like 5 years is a long time. That's like I don't know 6, 7, 8% of someone's regular life expectancy. It's just fascinating to think about how much things have changed and haven't changed. And like I will say, like all of the companies I talked about, of my top percent winners, none of these were names I owned in 2020 or 20. Like Meta, I bought it 2021, but that was when the stock was going up and everybody loved stock. And it was very different than a year and a half later when everybody hated the stock and it was going down, and I decided to do $90 of dumpster diving with that work study money. So just fascinating. Like a time like time is like time matters, and it's fascinating to think about just how the stories have changed or haven't changed for these stocks, and then for the companies fundamentally, what has changed or what hasn't changed. Like for Spotify, I'm sure someone you know who does more work in this stuff could poke holes in what I've said, but I think certainly for Joe Schmo, this is roughly like my perception. And again, clearly, I have horribly failed to trade any of these or failed to size appropriately. So like Meta, like Meta is the most unforgivable, just because like the terminal value was never in question. Was never in question. If there was actually bankruptcy risk, like you would know there's bankruptcy risk. I don't know how much of net worth, how much Zuck owns of a company, I forget. But if you see that going to zero, like you will adjust. Or again, honestly, like that should have been another obvious sign, because Zuck owns that much of a company, of his net worth. He has CZI, his foundation. He's not going to let it go to zero. Therefore, you have your put, you have your floor. Like in retrospect, it was so obvious, and that should have been like a clear go 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 buy 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 at that low point. I do suppose I could blame them Meta not buying a buttload of stock at the lows in 80s and 90s and 70s, but again, like it was all so obvious. But anyways, those are some ramblings. So appreciate any thoughts.